Okay, so let us continue after the break. We now talk about the effect of changes in the level of the yield curve on the value of a callable or a puttable bonds. Speaking simply, we want to know the impact of a change in the interest rates on the value of a callable or a puttable bond. This is very interesting, as we shall see very soon. Now, there are different effects of a change in interest rate on a callable bond. We shall examine each of these in detail. Number 1 or A, as you may see, as interest rates decline, the market value of the straight bond rises. Market value of the straight bond, please note this. The market value of the straight bond rises since the required return demanded by investors across the bonds falls. It's quite simple. As the level of market interest rates declines, it falls. The people in the market who are willing to invest, who are traders or investors in bonds, would demand a lower return, and as a result of which the straight bonds price will increase. As a result, now the second thing, that second impact that is very interesting. A rise in the price of the bonds raises the probability of exercise of the call by the issuer in the callable bond. What is a callable bond? It gives the right to the issuer to take back the bond, to call back the bond if the option turns out to be in the money, or if it decides to exercise the option, which the discretion is with the issuer of the bond. Now, obviously, because it is a call option, it would be exercised if the market price of the bond is higher than the exercise price of the option. Now, therefore, now suppose the interest rates are decreasing. That means what? That means the prices of the bonds across bonds would tend to increase for the reason that I have just elucidated, that is, the market return goes down. The return demanded by investors in the market goes down, and as a result of which the price increases. Price increases means there could be more situations, there could be more scenarios in which the price of the bond would be higher than the exercise price of the option, and as a result of which the option would be in the money, and as a result of which it would be profitable for the issuer to call back the bond. Therefore, what we are trying to say is simply that if the interest rates fall, the increase in prices across bonds would mean that there is a greater chance that at any particular node for that matter, that the exercise price would be lower and the market price would be higher, and as a result of which the call holder, that is the issuer of the bond, would prefer exercising the option. In other words, because these probabilities ultimately determine the price at which the embedded option is going to be valued, greater the probability of exercise of the option, greater would be the value attached to the option, because greater is the chance of making a profit out of that option, and therefore, greater would be the value of the call option in the bond, and as a result of which on this count, because the investor is short in the call option, on this particular count the value of the callable bond would decline. I repeat, the value of the call will increase. Why? Because the probability of its exercise increases. Why? Because the prices across bonds increases, and that means what? Because the investor is short in the call option, therefore, and the call option has become dearer, therefore, the investor would be pay even lesser for that particular bond. In other words, the price of the callable bond on this particular count, on the reason that the call option becomes more costly, will decrease. See, if the bond's market price increases, now this is another interesting feature which we can look at by going back to the example. Look at this example. Now, what you observe here is just a minute, this particular slide. Look at this particular slide. What is happening here is that when there is an embedded call option, as soon as the price at any particular node goes above the exercise price, the computed price is replaced by the exercise price. What does that mean? It means that as far as the investor is concerned, the upside that is generated or created on the bond decreases. Let me repeat, had this bond not had a call option, the payoff at this particular node at the node C would have been 101.594, but because of the embedded call option, we assume that the because the computed price is higher than the excess price, the issuer will access that option, and as a result of which the price which should have been 101.594 now goes down to 100. Therefore, the upside of the prices at various nodes is curtailed, is segregated, is reduced by the excise price, by a ceiling of excise price. Whenever at any particular node the option is excisable and the computed price exceeds the excise price, you have to replace it by the excise price. In other words, in totality the bond's upside is curtailed by the existence of the option. So, let me read it out now. If the bond's market price rises above the excise price due to fall in market interest rates, then the issuer may call back the bond and the investor has to deliver the bond back to the issuer at the excise price. Please note, the market price is higher, but because there is an embedded option and the issuer has excised the option, the investor has to return back the bond at the excise price, not the market price. I repeat, at the excise price, not the market price. Excise price is lower. Therefore, the upside on the bond from the perspective of the investor is curtailed, is truncated. Thus, the call option in the callable bond limits the bond's upside. That is precisely what I am trying to convey to you. The call option in the callable bond limits the bond's upside, because at any node where the option is excisable, the payoff will not exceed the excise price. So, the value of a callable bond rises less rapidly than the value of an otherwise equivalent straight bond. Why? Because of the call option being there. As the interest rates decline, the value of the bond increases, the value of the call option also increases, but because the investor is short in the call option, and the overall the price of the bond or the callable bond increases in price, but at a slower rate. Similarly, we can analyze the put option. As interest rates increase, the long put in a puttable bond hedges against the loss in value. Therefore, as the interest rates increase, because the put is long now and interest rate increase means the prices are declining. Therefore, the put option acts as a protection, acts as a hedge. So, where if the prices go down below the excise price of the put option, then the investor can exercise the put option and can get back the excise price instead of the market price. Thus, the value of a puttable bond falls less rapidly than the value of an otherwise equivalent straight bond, because the value of the put option, as the interest rates increase, what happens? Price declines. Price declines of what? Of the straight bond. But the put options probability, it gets probability of excise increases, and as a result of it the value of the put option increases. Now, the investor is long in the put option, and because the investor is long in the put option and the value of the put option has also increased, therefore, therefore there is a cumulative effect, and therefore, there is a cancelling effect. Rather, the price of the bond has decreased, the value of the put option has increased, and therefore, the price of the bond decreases slower than that of a straight bond. So, that is what is stated here. The value of a puttable bond falls less rapidly than the value of an otherwise equivalent straight bond. Why? Because the value of the put option increases, whereas the value of the straight bond decreases if there is an increase in interest rates. So, this summary in this slide summarizes whatever I have been discussing so far, and let us read it out slowly and carefully. Thus, if the interest rates decline, the value of the straight bond increases. This is as far as the callable bond is concerned. If the interest rates decline, we all know there is an inverse relationship between the price of a bond and the interest rates, and therefore, if interest rates fall, the price increases. The price increases means what? The value of the call option in the callable bond increases. Why? Because there is a greater probability of the exercise of the call option. However, thus both the value of the call and the value of the straight bond are inversely related to the level of interest rates. Lower decrease as the interest rates decrease, both the value of the straight bond increases and the value of the call also increases, because of the greater probability of exercise of the call. The callability of the bond also limits the bond's upside. At no node where the call becomes exercisable, you can exceed the exercise price. You will have to assume that the call is exercised, and therefore, the payoff at that particular point will be restricted to, will be truncated to the exercise price on the call. On all these counts, the value of the callable bond increases slower than that of a straight bond. On all these counts, the value of the callable bond increases slower than that of a straight bond if the interest rates decline. If the interest rates decline, let me repeat, the value of the callable bond, the value of the straight bond increases, the value of the call increases, but because the investor is short in the call, the rate of increase of the callable bond price is less than the rate of increase of the straight bond price. Now, for the puttable bond, if interest rates increase, the value of the straight bond decreases, the value of the straight bond decreases, inverse relationship. The probability of exercise of the put increases, the probability of exercise of the put increases. Why? Because the value of the straight bond value of the bond has decreased due to increase in interest rates. Therefore, there could be greater, therefore, there could be more situations, or there could be possibility of the possibility of a situation being more probable where the price of the bond is less and the exercise price of the put option is more, and as a result of which the investor will find it profitable to exercise the put option and sell it back to the issuer. Therefore, the probability of exercise of the put option increases, the value of the put option in the puttable bond increases. So, thus the value of the put changes directly and the value of the bond changes inversely with respect to changes in the interest rates. Overall, the value of the puttable bond decreases slower than that of a straight bond, because the holder of the puttable bond is long in the put option. So, that is as far as the level of interest rate, the impact of the level of interest rates on bonds with embedded options is multifold. First of all, the impact on the straight bond, the impact on the number one, the impact of the straight bond is inverse in all cases. The impact on the option, as you can see here, because the probability of exercise increases whether it is a call or a put. Therefore, in both cases the value of the put value of the option increases. Number 3, the bond's upside is limited in the case of a call option embedded instrument or a callable bond, and the downside is limited in the case of a bond with put option embedded in it. Overall, what happens is that the value of the bond in both cases moves inversely in relation to the interest rates, but at a slower rate compared to the corresponding straight bonds. Effect of changes in the shape of the yield curve on the value of callable or puttable bonds. Effect of changes in the shape. Please note, we have talked about the volatility, we have talked about the level of interest rates, and now we talk about the shape of the yield curve on the value of the callable or puttable bonds. Now, it is generally the case that the yield curves, which I shall explain in detail very soon, but the yield curves are basically plots of spot rates or interest rates corresponding to various maturities. We work out the interest rates corresponding to maturity of 1 year, 6 months, 1 year, 1.5 year, 2 years, and so on, and plot them as a graph, and that is what constitutes the spot yield curve or the standard yield curve. I repeat, standard yield curve is the plot of spot interest rates of different maturities, interest rates against corresponding maturities, or rather putting it the other way around, maturities with the corresponding interest rates along the y axis. Now, let us assume the following. Let us assume S01, that is the spot rate for a 1 year deposit, to be 3%, spot rate for a 2 year deposit, let us assume it to be 4.02%, and the spot rate for a 3-year deposit, let us assume it to be 5.069%. These are given figures. Then on the basis of these, if we work out the arbitrage free forward rates, what do we get? What we get is F01 is obviously coinciding with the spot rate, which is 3%. F12, that is a forward rate that operates between t equal to 1 to t equal to, that is from for a deposit that is initiated at t equal to 1 and up to t equal to 2, that is 5.05%. And what we find for F23, that is the forward rate that operates between t equal to 2 and t equal to 3 on the basis of arbitrage free pricing, what we find is that turns out to be 7.20%. Thus, one thing what we observe is that when the yield curve is upward sloping, please note this is a upward sloping yield curve. If you look at the spot rates are increasing with maturity. Spot rates increasing with maturity. This is called an upward sloping yield curve. It will be something like this. This is maturity. This is spot rate. Therefore, it will be something like this. So, as the maturity increases, the rate of interest increases, which is depicted in this example, this illustration. Okay, so when the yield curve is upward sloping, as we saw just now, the more distant 1 period forward rates are higher than the 1 period forward rates of the near future. As you can see here in this example, what do we have? We have F12 is equal to 5.05%, F23 is equal to 7.20%, and clearly F23 is greater than F12. So, the more distant the rate relates to, higher it is going to be compared to the rate which is at closer to today, provided the underlying premise is that it is an upward sloping yield curve. It is an upward sloping yield curve. This phenomenon relates to the upward sloping yield curve. The more distant you are in the future, the higher would be the forward rate compared to the closer you are to today. Now, upward sloping yield curve and the value of option bonds. We shall discuss the value of option bonds or the impact of impact on the price or the value of option bonds in the case of upward sloping yield curve. The value of an embedded call option decreases as interest rates increase, because higher interest rates lower the price of the straight bond and hence reduce the probability of exercise of the call. I have discussed this in a lot of detail already. As interest rates increase, the prices of the bonds across the market decreases, and as a result of which, if given a certain exercise price, the chance of a bond price exceeding the exercise price reduces, and that translates to a fall in the value of the call option. When the yield curve is upward sloping, the more distant 1 period forward rates are higher. The more I have just explained this with the by virtue of that example. The more distant 1 period forward rates are higher than the near forward rates or less distant forward rates. We saw that F23 was 7.20%, F13 was 5.02%, I think, and it was clearly seen that the F12 is much less than F23 or F23 is much greater than F12. Because the higher interest rate scenario reduces the probability of the call option being in the money, the value of a call option will be lower for an upward sloping yield curve. Because a higher interest rate scenario reduces the probability of the call option being in the money, the value of the call option will be lower for an upward sloping yield curve. As an upward sloping yield curve becomes flatter, the call option value increases. So, what do we have? On the one hand, higher interest rates means lower prices of bonds, lower probability of exercise of the call option, that is one impact. And secondly, higher interest rates also mean that the call option will also decrease in value, the bonds will also decrease in value. Thus, the value of on the other hand, what we have for the put option? The value of a put option increases with interest rates. When the yield curve is upward sloping, the probability of the put option going in the money is more. Why? Because the prices of the underlying assets are going down, they are suppressed, they are depressed because the interest rates are going up. So, if the interest rates increase, the probability of exercise of the put option increases, and therefore, the put value also increases, put option value therefore increases. When the curve flattens, what happens? The put option value decreases. Now, we talk about term structure of interest rates. What exactly is term structure? I have touched upon it in an earlier lecture, but basically when we talk about the term structure of interest rates, what we are trying to say is that the interest rates are a function of the maturity of the instrument. When you go to a bank and you make a deposit, what happens? Depending on the tenure of your deposit, depending on the tenure that you are planning to deposit or leave the money with the bank offers you a spectrum of rates, different rates corresponding to different maturities. This is what is called a term structure of interest rates. So, basically interest rates are a function of maturity of the underlying deposit, and that is what we call term structure. So, term structure of interest rate refers to the yields or interest rates on similar securities with different maturities. So, this is important, similar securities, similar in terms of the risk profile. Now, there are different types of yield curves. I have touched upon the spot yield curve a few minutes back. We also have the par yield curve, and we also have the forward yield curve. Spot yield curve. This yield curve shows spot rates by maturity. As I mentioned, on the x axis we have maturity, and on the y axis we have the corresponding spot rates. So, what are spot rates? Spot rates are yield to maturity on zero coupon bonds. And what is the yield to maturity? I will come back to it in a minute, but spot rates are basically yield to maturities on zero coupon bonds. As you can see here from the definition of yield to maturity, which I will elucidate in a minute, but which I have covered in a lot of detail in my course on SAPM, security analysis and portfolio management. The interested learner I would advise could refer to those lectures, but basically talking about YTM is that discount rate which such that when we discount all future cash flows attributable to a given instrument at that discount rate, we arrive at the current market price of the instrument. Let me repeat for the convenience of learners. It is that discount rate such that when we discount all future cash flows emanating from a security at that discount rate, we arrive at the current market price of the bond. So, for a zero coupon bond which has no intermittent cash flows, only the maturity cash flows, we arrive at this formula for YTM, because all the intermittent cash flows are 0, we just have the initial price, the cash outflow that when you take a position in the security, and the cash inflow when you get the maturity proceeds from the security at the end of its tenure, and therefore, we have this equation, all the other terms will be 0. Now, also we have using the formula for arbitrage free pricing and adapting that formula to the context of zero coupon bonds. Let me write down the formula using arbitrage free pricing. We have P0 is equal to summation Ct upon 1 plus S0 t to the power t equal to 1 to capital T. If you use this formula, put in all C1, C2, C3 equal to 0 except for the maturity cash flow, that is at capital T, and that is equal to the face value, we are assuming that, and then we get this expression. Let us call this equation number 1, let us call this equation number 2. Then clearly on comparing equation number 1 and 2, we get S0t is equal to y, and that is the rationale for this definition. Spot rates are the yield to maturity on 0 coupon bonds. And what are spot yield curves? Spot yield curves gives you the plot of various spot rates corresponding to different maturities. The maturities are along the x axis and the corresponding spot rates are along the y axis. Hence, the spot rate yield curve, spot curve depicts the YTMs of 0 coupon bonds of similar risk and of different maturities. Similar risk, but different maturities. The rationale I have already explained here. YTMs of 0 coupon bonds are determined solely by maturity and price. You can see here there are only two variables here. Assuming that this is fixed, we have only P0 and capital T. Y is a function of P0 and capital T, the current price and the term to maturity. YTMs for each maturity are determined by using the price. By using the price, we work out the YTM for a 1 year bond, for a 2 year bond. Usually it is at 6 months of 6 month bond, 1 year bond, 1.5 year bond, 2 year bond, and so on. We work it out on the basis of the price and 0 coupon bonds of appropriate maturities. This gives you the spot rate corresponding to those maturities, and then we plot those spot rates with respect to the maturities to get the spot curve, spot yield curve. We call it also the 0 curve or the strip curve. As far as YTM is concerned, YTM I have already defined for you. This is the explicit definition that I mentioned a few minutes back. YTM is the discount rate that equates the present value of future cash flows from the instrument to its current market price. Therefore, for a given price, the YTM depends on what? YTM depends on the magnitude of the cash flows and the timing of the cash flows. This is quite obvious from this. It depends on C and T given P0 and given the spectrum, given a particular bond. It depends on the magnitude of cash flows from that bond as well as the timing of those cash flows. YTM and riskiness. Now, this is important and this is interesting. For a given bond, YTM depends on the riskiness of the cash flows, since the price will incorporate the riskiness in the realization of these cash flows. You see, the basic thing is that price is that riskiness is a fundamental variable when we do any kind of investment analysis. As I mentioned, we do it investment analysis on a 2-dimensional framework. Number 1, the expected return, and number 2, the riskiness of in the realization of that expected return. So, the market has information about the riskiness of various securities that are traded in the market, and as a result of which the market incorporates that riskiness into the price of those securities, and therefore, the price adapts itself to the riskiness, and as a result of which the YTM depends on the riskiness of the cash flows that are going to be generated from a particular security. In other words, the YTM reflects the riskiness of the cash flows that are generated or that are expected to emanate from investment in a given security, and because the price will adjust itself accordingly. YTM is a risk adjusted discount rate that encapsulates the market's perception of the riskiness of the realizability of the cash flows from the instrument. This is what I have explained just now. Therefore, two bonds with identical cash flows may trade at different YTMs if their risk as perceived by the market is different, because the price will adjust accordingly. So, if you have two identical bonds with absolutely identical cash flows in terms of timing and magnitude, you may still find that those bonds are being traded at different prices, because the prices will encapsulate riskiness, and therefore, because they are being traded at different prices, although they are identical in terms of the timing and magnitude of cash flows, they will return different YTMs. In other words, the inference is that two cash flows which are identical but have different riskiness in the realizability of those cash flows will yield different YTMs. The more risky bond would quote at a lower price and hence a higher YTM. Similarly, if two bonds carry similar risk perception, and this is more interesting, if two bonds carry similar risk perceptions in the market, they would have the same YTM notwithstanding that their cash flow patterns are different. This part is very interesting. If you have two bonds with different cash flows, but with identical risk in the realizability of cash flows, the prices will align themselves in such a way that the YTM or the discount rate, that is that we call the YTM, happens to be the same. Prices will organize themselves in such a way. You see, the basic thing is that this discount rate or the YTM, whatever we call it, is representative of the return that an investor gets from a security. So, and this return is obviously a function of the riskiness and the realizability of the return. So, the bottom line is that if two bonds carry similar risk perceptions, they will give you the same YTM, notwithstanding the fact that they have different cash flows. Why? Because the prices will adjust accordingly. Suppose you have two bonds A and B. A has a cash flow of 1 unit over 3 years, 1 and 1, it is an annuity of 3 years, 1 unit. The B has an annuity of 2 and 2 at the end of year 1, 2 and 3, it is an annuity of 2 units of money. Then and they are identical in terms of their realizability risk, then what we will find is that the price of B bond is twice the price of the A bond. The prices will adjust themselves in tandem with the cash flows. If they have the same riskiness, the YTM will remain the same. An interpretation of YTM, this is where I will take up in the next lecture. Thank you.